back to Reflections and Real Talk. Today, I'm going to compare one of the biggest financial decisions that impacts your cash flow and your ability to save for retirement that most of us face at some point. Should you finance a vehicle or buy with cash outright? Living debt-free is an admirable goal and one I fully subscribe to. But when it comes to money, you should also weigh the opportunity cost of using the money for one purpose or another that might be more profitable. And what about the opportunity cost of laying out a big chunk of money versus investing that cash? I'll compare the cost to buy or finance a new vehicle at $60,000, $30,000, and $20,000 and show how that compares to investing just the additional finance fee or the entire amount with an estimated 6%, 8%, or 10% return rate. Plus, I'll talk about some extra bonus earnings you may realize as well. Deciding to finance a vehicle or buy one outright should start far earlier than when you're sitting at the dealership or having just driven your dream car and you're imagining driving off the lot onto the open highway. There's a reason that car salesmen have a reputation for being so slick. They are highly skilled at pulling at your heartstrings and spinning the numbers in a way that can be confusing or misleading until you get home and are stuck with the payment for 5 years. So make your decisions before you drive to the dealer or purchase a car from a private party. Stick around because this episode is packed with hard numbers to help you make smart decisions objectively so you won't have regrets later. Please consider subscribing to this channel now so I can continue to provide quality information to you at no cost. In addition to the cost of the vehicle, if you plan to finance a car, the interest rate you pay is a big factor in overall costs as well as miscellaneous fees such as state taxes, registration, and tags, which vary by state. According to Experian, here are the current rates for automobile financing as of December 2024. With excellent credit, you might be able to get a loan at around 5% for a new car loan or 7.4% for a used car loan. But if you fall somewhere in the middle, you can expect to pay closer to 10 to 14% or in the worst case between 15 to 22%. So for today's example, I'll use the 10% rate with a new car purchase. And if you want to plug in particular car an exact price and interest rate, you can calculate your own numbers using this free online calculator. I'll drop a link in the description below. The numbers may surprise you. By the way, if a car dealer offers 0% financing, that may be a more attractive offer, but that's a discussion for another video. With scenario number 1, this should give us a true comparison from a purely objective viewpoint. The cost of financing includes the interest you pay, but also the opportunity cost of using that same money you would have paid the dealer or their finance company. You can keep the money yourself by paying cash for the car and investing it in order to grow your own nest egg. Basically, you're acting as your own bank. So first, let's calculate the interest payments, which is the most obvious cash outlay. We'll also look at 2 more savings opportunities later you may not have thought about, right after this one. With a loan rate of 10% over 5 years for the $60,000 vehicle, you'll pay a total of $76,440. That's $16,440 in interest. Wow! At the $30,000 price point, you'll pay a total of $38,220 with $8,220 in interest. Nothing to sneeze at. And with the $20,000 vehicle, you'll pay $25,500 in total payments and $5,500 in interest. Notice how the interest adds up quickly, especially for the higher priced cars. If you paid cash without any additional calculations, these numbers represent savings you can bank on. And here's what your monthly payments will look like. For a $60,000 car, $1,274 per month, $30,000 car, $637 per month, and a $20,000 car, $425 a month. You should ask yourself, can you afford those payments? Because when you're at the car dealer deciding to get the leather seats or pearl finish upgrade, those marginal differences may not be easy to equate to the monthly cash outlays. What if you lose your job or you want to move to a more expensive apartment or have other unexpected expenses? Those are other considerations when obligating yourself to 5 years of consistent payments you should give some serious thought to before signing on the dotted line. But if you do have a steady career and emergency savings in the bank, maybe you can afford to buy your dream car now. In scenario number 2, we'll examine the opportunity cost to finance a car versus investing the money instead. Let's take a look and see how much you could earn on the money you save that you would have spent on interest payments alone. On the $60,000 vehicle, you would have paid over $16,000 in interest, but could earn between $5,000 to over $10,000 in earnings.
For the $30,000 vehicle, you would have paid over $8,000 in interest, but instead could have earned between $2,000 to over $5,000 in earnings. And lastly, on the $20,000 vehicle, you would have paid $5,500 in interest, but instead could have realized between $1,900 to over $3,500 in earnings.
So again, just looking at the earnings potential on the interest alone, you can clearly see that investing the money you would have spent financing could help you grow your nest egg considerably. And even at 6% return, the numbers are impressive, but remember, these are potential earnings not guaranteed. Scenario number 3. Next, let's look at another savings opportunity, earning interest on the front end, earning a more modest 5% in interest over 5 years. When you can anticipate how much you will need and save the money in advance in order to pay cash for your next vehicle. For example, to save $60,000, you would only need to save $56,000, earning $4,000 in interest. For $30,000, you'd only need to save $28,000, earning $2,000 in interest. To save $20,000, you'd only need to save $18,660, earning $1,330 in interest. And here's how much you should plan to set aside monthly to achieve your goal.
To save $60,000, you would need to set aside $1,132 a month. To save $30,000, you'd need to set aside $566 a month. And to save $20,000, $377 a month at 5% interest compounded monthly for 5 years.
Remember, these calculations assume consistent monthly contributions with interest compounded monthly. If you can automatically deduct that amount from your paycheck or set up a monthly transfer that makes it easier to set it and forget it. Scenario number 4, invest in your entire cash lump sum. If you earn annual return rates of 6%, 8%, or 10%, here's how much your investment could grow in 5 years. $60,000 investment at 6%, $80,305. At 8%, $88,053. And at 10%, $96,615. For a $30,000 investment at 6%, $40,153. At 8%, $44,027. 10%, $48,307. And finally, $20,000 investment at 6%, $26,768. 8%, $29,351, and at 10%, $32,205. These numbers are nothing to sneeze at. With investing, there are no guaranteed returns, but one thing is certain: giving your money to the dealer or financing company guarantees the money won't be yours. If you're still watching this video, here's what the real analytical viewers have been waiting for: net gains or losses. Scenario number 5. Now let's say you have the cash to buy the car outright, but instead choose to finance it. Is that a better return on investment? Even if you're paying 10% and you earn 10%, it seems like a wash, right? To see if financing versus investing is worth it, we have to subtract the total loan cost from the investment earnings. Here's how that works out at 6%, 8%, and 10%, with a net return range between $3,800 to over $20,000 on the $60,000 car. Those numbers let you visualize that being your own banker can really pay off. For the $30,000 car, the numbers are smaller, but at 8% or 10%, those amounts may earn you enough to pay for upgrades like the leather seats or the best sound system. Even at the $20,000 vehicle, the net returns could be noteworthy and beat giving your money away to somebody else. Borrowing at 10% while earning only 6%, 8%, or 10% results in a net loss for all car price points. That's because the cost of financing is higher than the return on investment. This is a result of the compound interest. Here's some practical advice. Avoid borrowing at high interest rates. It's better to save money up front and choose a lower cost car to avoid unnecessary finance charges. Invest cautiously. Focus on investments that can realistically outpace your borrowing costs, but remember that higher returns come with higher risks. Living within your means. Aim to purchase a car you can afford without stretching your budget, leaving room for savings and retirement. And here's the bottom line. Cars are a depreciating asset, which means they lose value over time. So whether you choose to finance, save, or invest, the key is planning ahead. Let's look at how often Americans buy cars. What is the average cost of a new or used car today? And how much of your overall lifetime wealth can you expect to pay for the privilege of owning a car? The Federal Highway Administration states that the average American buys a new or used car roughly every 6 to 8 years. Life events, wear and tear, and changing needs drive most car purchases, as well as the balance between reliability and cost. According to Car and Driver, a vehicle on the U.S. roads are an average of 12.6 years old. This tells us that while cars are lasting longer, this doesn't prevent people from wanting to buy new cars more frequently. And according to Kelley Blue Book, the average price of a new car is roughly $48,000. Meanwhile, used cars come in at an average of $27,000. They state that the costs are rising due to inflation, supply chain issues, and increasing demand for tech-loaded vehicles. Using today's average price of a car of $48,000 with replacement cycle every 6 to 8 years over your life, you can expect to own between 8 to 10 cars in your lifetime between the ages of 16 and 80. Without factoring the various prices of cars at each age, the cost of inflation and interest rates, this is nearly $500,000 in today's dollars. That's a big chunk of change. Regardless of how you choose to pay for your next vehicle, if you're in an area of the country where you know you'll need a car and the lack of public transportation is scarce or expensive, planning for a car purchase needs to be a big part of your overall financial planning strategy for life and retirement. If you have a 12-year-old child that will need a car by the age of 16, encourage them to take a part-time job mowing lawns or babysitting to start saving now. You could add some additional motivation like matching dollar for dollar so they can watch those savings grow. This plants the seeds for a savings mentality that will last a lifetime to save now, buy later. And the bonus is that they will really appreciate the car that they earn themselves, adding to pride of ownership. If you're a young adult and just getting started in a career, living paycheck to paycheck, it may be very hard to consider putting any extra money aside for future car purchases years down the road. If you're a retiree, perhaps you've overlooked replacing a car in your long-term budget, but it shouldn't come as a surprise that you will need to replace your car in the future. At any age, budgeting for a car is something we should anticipate. How can you make buying and financing vehicles throughout your life work for you financially instead of against you? If you're in the market, it's essential to evaluate your budget, consider the total cost of ownership, and decide whether new or used fits your needs. Here are some tips to help you decide when and how to buy your next car. Know your numbers. Factor in monthly payments, insurance, and maintenance. Buy at the right time. Dealers often offer discounts during year-end sales or model transitions. Consider certified pre-owned vehicles. These give you a like-new car experience at a lower price. Consider buying a used car from a private party. Make sure to have it checked out by an auto mechanic to reduce surprises first. Don't skip the test drive. Make sure the car fits your lifestyle and comfort. Assess your financial situation before committing to a car loan and ask yourself, do I really need a brand new car? Can I afford the monthly payment comfortably? Am I prepared for maintenance costs? And here are some steps to make your savings plans realistic and achievable. Automate your savings. Set up an automatic monthly transfer to your savings account to ensure consistency. Stay committed. Treat your monthly savings as a non-negotiable expense like rent or utilities. Review annually. Check your progress at least once a year to ensure you're on track and adjust if necessary. Saving for a large purchase like a car in advance has several benefits. No debt. You avoid paying loan interest, which can save you thousands. Peace of mind. You'll own your car outright and won't have monthly payments hanging over your head. Financial discipline. Planning and savings helps develop habits that will benefit your long-term financial health. There's nothing more satisfying than driving a car you own outright. Living within your means is the key to financial freedom. By planning for large expenses like cars, you'll avoid unnecessary debt and free up money to invest in your future. Imagine how peaceful it feels to have no car payment and know your money is working for you instead of going to the bank. Whether you're paying cash, financing, or investing, the key is to make an informed decision that aligns with your financial goals. So whether you're buying a car for the first time or upgrading after a decade, remember to shop smart and stay within your budget. Thanks for tuning in to Reflections in Real Talk. I hope this video helps you think critically about your next car purchase. Don't forget to like, subscribe, and comment, and subscribe for more practical tips to build your financial future. Share your car buying experiences in the comments below. What's your take? Would you rather finance, save, or invest? And remember, a little planning goes a long way toward living a stress-free and secure life. See you next time, and until then, take care and drive safe.